All right. Hi, everyone. I'm Melody, the Investor Relations Manager at Greenleaf. Today, we are doing our live stream. We're going to be discussing our new offering, Research Court. And I'm just going to kick it right over to our investments team, Dave and Nathan. I do want to say, if you have questions, feel free to submit them at the bottom of your screen. Thank you.
All right. Thank you very much, Melody. We're back
Friday.
doing one. I know it's Friday, July 4th is coming up. Hope everyone has some fun plans for this weekend. We figured we'd get the excitement of the Research Court one going prior to the long weekend. And everyone kind of kicking off their big summer parties, basically. That's what it seems like is going to happen. So Research Court, this is an exciting one. It's all medical, and it's right here, literally right down the street from where we're sitting. So it's something we're always been trying to find medical. It's been a little tough finding good ones lately, but we're excited about this one. So we're going to dive in, and Nathan and I are going to give you a little bit of background of what's going on with this deal. Pause.
Maybe. There we go.
There we go. We're in our new studio space.
Studio
Figuring out how it all
Working out,
works.
So this deal, this is right in Johns Creek. So this is literally 2 miles from where our office is at the station here. And we've got a deal where it's 95% occupied out of the gates and all medical.
There we go. That's what you're looking for right now. In times of kind of, erratic markets, being in a solid market in Johns Creek, being in Atlanta, and then having these medical tenants with long-term leases, it's a really nice conservative approach to investing that it's a good one that we found.
Yeah. And our lease term here is over 5 years.
That's right.
So we have long-term commitments from literally 94.5% of the tenants that are in the space. The only other one is one vacancy, and
we've got some activity on it.
Yeah, that's a good thing because we can get higher rents there. So overall, the description of Research Court, highly medical focused and in a very good location, literally pitching wedges away from the hospital.
Sure. Yeah. So for everyone used to ROMs, you'll see this page we have up on the screen, and there's a lot of text, but to sum it down to 5 main bullet points. This is a stabilized deal, like Dave mentioned, with medical tenants, and there's still some room to add value to lease it up, the vacant space. Tremendous location. Dave said, what, a gap wedge to the.
It depends how hard you're hitting.
It's a driver if it goes straight from this location to the 3rd ranked hospital in Georgia, so one of the top hospitals in the whole state. And then we've got really solid anchor base with Fresenius, a giant dialysis clinic with over 3,000 locations in the U.S. And then we're getting it at a really low basis, which if you ever watch these webinars, that's typically a theme that is common with Greenleaf.
It's been a long-running trend of our goal is find good basis.
We get a good basis on it. We're buying it, as you see, about a little over $150 a square foot. CoStar groups properties like this on average in kind of the mid 170s a square foot. And then there's other properties that have sold that are similar to ours that have traded for, 190 to 210 a square foot. So it feels really good buying it.
Immediate area.
All in that immediate area, very tight, which we'll look at, a few slides from now.
All right, so we touched base a little bit on this location here, but you also see we've got 2 other leaves on here, and these are medical buildings that we own that are in the immediate area. So one of the things we're comfortable with is knowing we already are here operating other assets that are very similar to what this looks like.
Right. And another benefit of that is, we can look at our Rolodex of tenants of these properties and look at a great tenant and go to them and see if they want to expand. So the more buildings we buy in the area or in the market, we have people we can go to and we can grow their business with our business as we acquire more properties.
Correct. Yeah, with the Parsons Meadow deal, we've leased space there to medical tenants, and then also Parkland Commons. That's another one where we had tenant expansion at that location. We had a pharmacy that basically is doubling in size. That's there. So.
I think a lot of the reason for the activity kind of in this area of Atlanta is, as you see on the slide, Northside has a big hospital, Emory has a big hospital there, like we mentioned. And so doctor practices want to be around hospitals. That's where they
Makes
get
it a lot easier,
referrals.
doesn't
That's where they want to be. And so, it's really a big driver for ours of buying this property and kind of increasing the stickiness of the medical tenants and, being close to where they want to be.
Yeah, definitely. We talk about sales comparable. So you mentioned we're getting this at a good basis. We're getting it for $153 a square foot. Here we have, we mentioned some of the other deals that we own that are also on here, but you can see some of the comparables that are other stuff in the market. And some of it's priced, like the one at 360 a square foot. That's a lot different than what we're paying.
Sure.
Stuff.
We like to throw in a wide variety of what other properties have traded for. And some being, very good comps, being single story like ours, and having mostly medical tenants like ours, and maybe less, surgery centers or less operating rooms and more, dialysis clinics or chiropractors, dentists, or there's a big theme at Research Court with autism therapy. There's 3 different tenants that all kind of focus on that arena of healthcare. So the ones that are selling for over the 300, that's usually, less tenants, more of a net lease, and more, seeing patients or operating or having heavy build outs.
Yeah, so $1 per square foot that they've invested in tenant improvements is a lot higher,
Right.
Than different services in the medical space.
Right. Some of those tenants, they'll put in $100, $200 a square foot to build out those nice MRI machines or operating tables. And Research Court, we're budgeting $40 a square foot, which should be plenty to kind of get that entry level medical type tenant and still get credit for it on the exit.
Right, being all medical.
Basis, being medical.
So so $40 a square foot, that's a lot of dollars going into a deal. It's not 200 though, right? It's not like a full surgical center that's being built out.
So we can get a discount medical property that still gets some of the consistency and
the value.
On the back end.
We look at lease comparables. So all these different assets, when you're talking about a surgery center versus kind of a standard medical versus even an office or some other use structure, we have very different leases on how those are executed. So here we have a pretty low rent compared to what we're seeing in the market.
Sure. So these comps we put up here on the slide, range anywhere from $17 to $30 a square foot on a net basis. So with the tenant paying all of the expenses. And we're in the high teens, a little over 18, and it's a full service gross model to where up into a certain level of expenses, Greenleaf is paying for all of those expenses. So on a net basis, it's probably more like $13.
Yeah. So we're getting an asset that has below market rents right now,
which is great. So when a lease comes for renewal and a tenant's there, they go look out in the market, they're seeing 17 plus net rents, and they look at us and they're only charging. They're only paying $13 or $14 net.
And these lease comps
makes it hard for them to move.
These are all in the immediate area. These are not like spread out over a wide city. These are pretty much on one road.
Right. They're all within our property to the hospital and then draw a radius around it. So less than a mile. So it's a really tight radius to see, what kind of leasing activity there are.
And they're all pretty similar buildings. We're looking at mostly all brick structures, flat roofs, 1 and 2 stories assets that are here.
Right.
So investment overview as a whole, one of the biggest things we're getting with this deal, there's a lot of movement right now. Everyone is tracking inflation and everyone is tracking kind of interest rates and seeing where things are at. On the interest rate front, the Fed is certainly raising rates. But we're also seeing that they're not even to the level yet that they were in 2018 and 19. Recall the Fed rate back then was like 2.4%. So we're still a little below that, but the Fed's definitely raising, probably going to go past that right now. But in the meantime, we're able to get pretty fantastic debt on this asset.
Right. So we're presenting this deal today, but we've been working on it for months in the past. And so right as the debt markets got a little choppy is when we put this one under contract. So, even we were, a little hesitant to see where the debt would shake out, but we ended up getting, locking in a 4.5% interest rate for 5 years. So, the whole length of the term we plan on holding it. And we got it with a local lender that we've done deals with before, who has confidence in us. They know the asset, they know the market, and they were comfortable, to win the deal coming in more aggressive than, we were seeing from other vendors we've worked with in the past.
Yeah, so that fixed debt for the length of our hold period really helps us put some stability around what this asset looks like. So we've got fixed debt at 4.5%. We have our expenses that are basically covered by the tenants. So any changes in those, they're paying on those expenses. And we have built-in escalations in all of our leases, and we're below market on those rates.
So 3 great inflation hedges.
Yeah.
And, if we were repricing this debt today, I don't think we would get the 70% leverage we're getting. And I think we'd be 100 basis points higher.
Yeah, it would definitely be in the 5s. Right. And the loan to value part could be, the current quotes we get on deals, we're seeing a much larger spread in what that loan to value number could be.
Sure.
So the other part we want to touch base on here is our capital improvements compared to we've got a big number written in here, this $500,000 for a seller CapEx credit, right? Nathan trying to get money from each seller every time.
Always.
Sometimes.
so going into the deal, seller acknowledged the roof's original. I think the properties were built early 2000s. They've reached their useful life. And instead of them putting that cost in and repairing it and then charging a higher price to us, they said, we'll just let you guys do it. Tell us how much the quote comes in at, and we'll deduct that off the price. So we've got 500,000 in there, and I think it's going to shake out, right at about that number after we got all of our inspections back.
Yeah, this is a 80,000 square foot building, so it's a relatively large roof that we're putting on there. And that $500,000, we have some contingency in there, but it also applies to our total capital improvements. So you see our total capex at $1 million, and then 500,000 of that is roof.
Right, majority.
Yeah, majority of it's roof. So it's a big chunk of roof that is there. And our returns and our structures on this is a standard deal we're doing with the 70-30 profit sharing and a 7% preferred return on the deal. We put this slide in here. We want to talk a little bit about what the rent roll is and who these tenants are that are here. The largest one at the top is what you spoke about, the dialysis clinic, publicly traded with 3,400, over 3,000 locations.
Thousands of locations, for sure.
It's crazy the scale that they have. And
I think they're about 50% of the market. There's really 2 major dialysis clinics in the US, and this is one of them. And strong balance sheet, growing, a great anchor to have on the rent roll. And if that dialysis clinic was in a building by itself, those deals trade in the 5 cap range, 5 to 6 cap. So we're getting kind of that juice and credit, that juice and cap rate, paired in our building with multi-tenants.
Yeah. And here you also can see the lease escalations that are already built into the leases that are in place. And again, our weighted average lease term is over 5 years. So these escalations are taking place on an annual basis that are triggering through on all the leases.
Every year we do nothing and their rent goes up. So it's a great inflation hedge.
And the one vacancy we do have here, this 4,300 square feet, that's the spot that we budgeted $40 a square foot to
attract a medical tenant to kind of fit in the profile in this front roll.
So the bulk of our capital improvements, we've got this roof and we've got a chunk of vacancy that we are preparing to spend a good amount of money on to fill that last space.
Leasing cost. Sure. Yeah, and the last thing I'll say about this slide on the rent roll is there's the column lease start. And if you scroll down the column, which is kind of in the middle of the page, you'll notice there's almost no leases that were executed pre-2020. So all of this leasing has been done, one, during COVID, because the building is single story, it's got exterior entrances, dedicated HVACs. But anytime a lease is signed, new or renewal, there's typically some TI involved from the landlord. And so this deal is in good shape because all these new leases means the landlord and tenant typically are putting in money to upgrade these spaces. So if one tenant were to leave, if they were to default or go bankrupt and leave in a year, we've got a pretty well built out space that can accommodate someone just to move in.
Yeah, it's not like a tenant that's been in there for 15 years and you've got a pretty dingy environment.
Right. And I've walked all the spaces. It's nice space that wouldn't have to do too much unless the incoming tenant, really had some specific desires.
That's like they have to have a fundamental shift in kind of how they're using the space.
Right. You'll be able to find someone who could just take the space as is.
Very cool. Okay. So financial pro formas, this one, we know there's always a lot of numbers on this one, but we really like this slide because it shows us the trajectory of the deal over the 5-year hold period that we're looking at. And we see everything here from assumptions with some increase in costs, what our rental rates look like as they're going over the years. And you can see the net income at the bottom of this includes all of our reserves that we're building. So we have our net income, and then we have all the reserves that we're building every year to prepare for if anything happens on the leasing front. If we need to do anything, if we need any CapEx work, we're reserving for that. But if we don't spend that, that money's there.
Right. Right. It's a very stable, conservative approach to money management, which is a tribute to Dave. He fits his personality. At top end, we've got a vacancy factor built in that no matter what, if the building's 100% full, we're still going to credit it to where the market is, which is kind of mid 90% range. So that's a conservative element. And then we're reserving, every year over $2 a square foot to plan for any kind of tenant turnover, even though our WALT's 5 years and it's not likely to have anyone move out.
You see, year 3, we still have $80,000 in vacancy assumed in there. And on the upfront, we have this $40 a square foot to help a new tenant move in there and build out that space. In all of our markets that we've seen in Atlanta on the medical front, we have actively been signing medical-based leases in all of those assets. So we're pretty confident in our ability to execute a new lease in this, and optimistic we can do it for under $40 a square foot. But $40 a square foot is a good buffer for us that we can make commitments with a new tenant and get them in.
Right. We view these medical deals as recession resistant. People are still going to go to the doctor, with illness or for this, that,
we're playing a demographic bet on that one right there with a larger percentage of our population, as it's just an older population, going to need medical care. And this is a great location for it because right next to all the hospitals. Yeah,
the dialysis clinic, it's something to see. They're not open 5 days a week. They're open 3 days a week. And most of their work, their procedures are for elderly, and they all come from one place. So there's buses that come in, unload people, and they're on the dialysis all day, and then they're gone. And when I've been there and seen it, it's hundreds of people, and they cram it into 3 days a week and run through everybody. So they're busy.
Yeah, definitely. So we touched base on some of the capital improvements. This gives you a pretty good picture of what the building looks like as well. And you can get an idea of the scale of how big the roof would be on such a large, 80,000 square foot platform.
Big full plates. Yeah, single stories, a lot of roof.
So we have that built in here. And you can see our TI not only is tenant improvements, but it's also the lease commissions that are tied to that. So if we sign a new lease, we are paying, for the most part, if it's over 2,000 square feet, there's normally a broker involved that we're paying on the tenant side.
Right.
So occasionally, if it's under 2,000 square feet, we will have a lease where there's not a tenant side broker. But in this case, it's 4,500 square feet. So there's most likely going to be a broker.
The medical tenants tend to be a little more savvy, and they realize the value of having that broker, knowing the market, knowing available opportunities, and then having them be there to negotiate for the best terms.
So we're planning for that. That's definitely in the system. But other than that, we have some contingency and soft costs, assuming we are going to be doing a big TI build out for one suite, and assuming the roof replacement. But that's really the bulk of the CapEx that we're doing.
It's in great condition. It's been institutionally owned. It was institutionally developed. So, there's not a lot of deferred maintenance. And you see by the pictures, it's a beautiful space, well landscaped, taken care of.
All right. So the last slide here is our cash flow and our forward-looking estimate of what we're doing on an IRR perspective here. So we have our standard, what does it look like if you invest $100,000 in the cash flows that are generated out of that? And that includes the sale in year 5. And in this, we're looking at a 7% cap rate as exit, which is higher than most medical that's out there. We are seeing that, look, if cap rates are going to rise, even at 7%, this is still a mid-teens IRR that we're seeing on this deal.
Right. It's pretty conservative. I was having lunch with a healthcare broker yesterday, and they're bringing to market a portfolio of 4 medical properties, multi-tenant, similar to our type property. And one of them is actually in Johns Creek, what was it, sandwich away from our property. And they're targeting, low 6 cap in the exit. So I think that's a good, barrier, kind of safety cushion, that they're targeting 6, and then we're performing, a 7 out in the future.
Yeah.
No questions?
Okay. All righty.
All
Thanks
right.
very much, everyone. Have a good 4th of July.
Take care.
Bye.